How long will U.S. rates rise? This is Andrew Stotz of the Become a Better Investor community. Let's get started. So first we're going to look at U.S. rates and how they're passing the prior 2018 peak and halfway to the 2007 peak, which happened just before the 2008 crash. We'll also see how the yield curve is flat and moving towards inversion. So we'll start with U.S. rates. The U.S. 3-month government bond is at 2.4%, a massive increase from almost zero previously. And it's close to its December 2018 2.45% peak, and halfway to the peak in February 2007. That was 5.1%, and that was just before the market cracked and the economy cracked. In fact, the Fed had been increasing interest rates from 2003 or so all the way up till 2007 when it hit its peak. So we're maybe going through the exact same cycle. Also, we can see that in 2019, it was a max for Americas, the green line, which was hitting 5.3%. It was going through its own issues at that time across the Americas. Now, U.S. 1 year is at 3.1%, which has already broken through its December 18 peak. If we look at U.S. 3-year rates, we're at 3.1% also, and it's already, again, broken through. Now, when it comes to 5% or 5-year U.S. bonds, they're at 3.1% too. So the yield curve's kind of flat at this point. It's in line with the prior peak. And here we can see somewhat similar that the U.S. 10-year is at 2.9, which is just slightly below its prior peak of about 3% that happened back in 2018. And then finally, we can see that the 30-year government bond is at 3.1%. Who cares about inflation? Nobody's pricing in much inflation in that. The assumptions there is maybe you could say 1.5% inflation rate that's being factored in to that 30-year government bond. If you want to join the Become a Better Investor community and get more stuff like this, well, just click the link in the description and learn more. So now let's look at the yield curve for a bit. Since 2021, the U.S. yield curve have moved to be flat. You can see the green line here shows that as of July 2022, it's flat. And that's a pretty big move compared to where we were in 2021, when, for instance, 3-month bond yields were at zero almost, and now they're at 2.5%. So a huge shift in the short end of the curve and a small shift in the long end of the curve. And I would say that based upon what expectations are about the Fed going forward, people are expecting 75 to 100 basis points rise in Fed funds rate, which would basically put the curve into an inversion. Now, in developed markets, it's much lower. You can see there's a slight normal or upward slope in the yield curve for developed markets, but a lot of that's just because Japan, Europe, Germany, these countries have super low rates, which is depressing the short end of the yield curve. So it is a normal yield curve, less of an inversion. But recently the EU has said that they're going to start raising rates, and that could start to bring us more towards a flat curve. In the Americas, there's a slight inversion right now, a slight inversion. Remember that countries outside of, let's say, strong countries like the U.S., as an example, they're under a lot of pressure right now. They've got to raise their short-term rates in particular just to protect their currencies and other factors. So there's a lot of other things going on. But in the U.S., I would also say that we're getting close to that yield curve inversion. And in the developed markets in the Americas, which is mainly U.S., Canada, we can see it's about flat. Finally, let's bring it all together and look at the world. And the world bond yield curve, we can see, is about flat also. It's risen about 1.5% all along the curve compared to where it was at the end of 2021. So my question to you is, how long will U.S. interest rates rise? I think that we'll see a very another increase possibly from the Fed, and then a crash in the market and a crash in the economy, and that's going to cause the Fed to have to come back down. So these rising interest rates, I believe, won't last that long. What do you think?